Good afternoon, everybody. Welcome to the TraderMerlin Show. It is your Tuesday afternoon, an exciting Tuesday, another big aggressive down day for our markets. Bitcoin down over 2%. A lot of these indexes getting near that 2% mark as well. We are going to talk about, all things market related today, as we typically do, but I'll do that a little bit later on because our guest joining us today is going to bring in a little bit of a different topic. Here we are getting into October, first week of October. Yes, I know we've got October, November, and December. So you got 3 months to get ready for the end of the year. But in my years of being involved in financial markets, I know that a lot of people are procrastinators. We wait to the very last second, right? You go down to the wire and you might be impulsive or not make the right decisions near the end of the year. So I thought it would be better to do this show now versus mid-December. And that show topic is end of year tax planning with Justin Krebs of theproactiveinvestor.com. So Justin, welcome to the program. Good to have you back. How you doing?
Good, Merlin. How are you doing, buddy?
Good. Always great to have you with the program. He's in the vehicle today, guys. So you don't get any. You've got no picture or no video, but we'll have a picture of him up here all the time. So good to have you back on. And what's new in your world? Anything exciting?
I mean, the question is that are people really disappointed with not seeing my face?
I think so. I think you bring a lot to the table there. You always got you have a nice smile. You seem happy. So yeah, I think people miss it, but they'll just have to deal with my ugly, unshaven mug.
Well, yeah, I'm right now. I'm just playing kid Uber. With all the kids I've got in my household, I'm just running back and forth. And unfortunately, I got called into duty at the last minute here. So
that will happen. No big deal. It's all right. We love that you took the time to actually get on the phone and join us today. So let's talk about end of year tax planning. And obviously, when I knew you, you were a very active trader and doing a lot of education in the trading space. You've subsequently gone and done a more financial planning advisory role type of thing. So you are much more of the front lines in dealing with customers and seeing both the strengths and the weaknesses of clients that come to you. From when I was working with a financial planning firm, and I wasn't the one actually doing the financial advising, I was just in the back end listening to everybody complain when the customers left. One of the things that always came up was how unprepared and ill allocated or just some of the problems that the customers had. So maybe you can start by saying, what are some of the common problems you see and things that people may be able to do to address those as they approach the end of the year?
That's a good thought, because when people call them people call themselves advisors, and they just really only advise on one part of the entire plan, and that's usually the investment portfolio, the buys and sells and all that stuff. But when I became an advisor, I kind of wanted to make sure that I was managing all the elements of the retirement plan, which is income, investment portfolio, but also things like taxes and legacy and estate and healthcare and things of that nature. All the little elements that actually do go into a full-fledged plan. So when I bring on a client, we're not just talking about the investment portfolio and what to do at the end of the year. It's also other things that we should kind of look either review and plan for next year or preview for the upcoming year. So there's a few things that we should probably talk about, like year-end planning strategies, and there's kind of 4 areas. One is kind of income and how to manage that income tax. 2 would be investment portfolios. 3 would be personal retirement planning, and then 4 would be kind of the legacy or the wealth aspect of it. So I guess we just start with kind of the simplest stuff, like the income and the income planning, which is what people typically think of when it comes to taxes. One of the things that I work with is I work with a lot of business owners. So working with business owners, I just make sure that, they're taking they're managing their tax bracket, because business owners usually have some kind of tax structure set up, S Corp, LLCs, even C Corps. And it's just all about kind of managing that, managing those income brackets, which you can manage those income brackets. And if you're too close to one, you could do charitable donations or deductions, or you could contribute to a retirement plan or something of that nature, kind of bring those things down. But recognize capital losses, things like that. You could even defer retirement account distributions if you have a higher tax year. There's certain things that,
yeah, there's a few. One thing that pops into my mind when I think of kind of, let's say I'm near a tax bracket and I would like to maybe get underneath that. What about gifting? I think you can gift up to $14,000 per year tax free to somebody. Is that a factor as well? Does that come out of that taxable income? So if, let's say I'm at just over the line for the tax bracket, I'll just go and gift enough to drop into the one below it.
I mean, the gifting doesn't really come into. Gifting is one of those things that doesn't really help you,
okay.
Unless you're really planning on having a very large estate at the end of your life, because the gifting can go into all the stuff that you can give essentially tax free without any issues while you're still living, and that's up to a certain limit. I think it's something crazy like 11 million or something like that by the end of your life. So that's only for really wealthy people.
Uh-huh.
But yeah, I think in 2023 it's 17,000 that you can gift, but that usually falls in more of like kind of the legacy aspect of it. But if you are thinking more of like a donations, you can, like charitable contributions, and there's ways that there's actually pretty creative ways that you can do charitable contributions. You can actually bunch them up in something called an advisor. What is it called? It's donor advised fund. Which I'll give you an example. So I do this with several of my clients, where let's say they give $10,000 to a church every year, and they know that they're consistently doing that and plan on doing that for the next 10 years. But let's say their income, for whatever reason, whether it's they had a lot of business income, or maybe they're retired and we're doing a Roth conversion or something like that. But let's say they had to recognize a bunch of income. Well, we might just do a donor advised fund, which we'll just take the 10,000 that they do every year for the next 10 years, and we'll bunch it into, we'll donate that 100,000 to a donor advised fund. Now, the donor advised fund is still, you can control it in the market, right? You can, it goes up and down, whatever you invest in, whatever that may be. But you can immediately write off that $100,000 for that year. So instead of $10,000, you can write off the entire lump sum donation of $100,000. But what's unique about that is that $100,000, you can control it every year. So you can only give $10,000 this year if you want to, $5,000 the next year, or $20,000 the next year. It doesn't matter.
Right.
You're just basically taking all your deductions for the $100,000 that you were planned on over the next 10 years. You're taking it all at once to offset a big income.
Interesting. And that's what donor advised fund is what you called that?
Donor advised fund, yeah. And there's other similar type structures, but that's kind of it's kind of like actually setting up a more controllable family foundation. But it's just, you're just doing it with specific charities.
Yeah, so, typically with the income side of things, there are other deductions. It's about identifying what tax bracket you're going to be in, and it's different little allocations you can make to maybe drop yourself into lower tax brackets and just make the most of the cash that you have. Your second one you mentioned was investment planning, and I think that this is where it's much more strategic depending on the person, because obviously every one of us is going to have different goals and objectives for our investment planning. But what are some of the high-level pieces that they should be paying attention to?
Well, obviously, capital gains, paying attention to things like wash sales. I don't know if people know this, but there's ways to get around the wash sale rule. There's a couple different strategies that you could use, including, traditionally you can just wait 30 days. So in other words, if you have to sell something at a loss, right, you have to basically wait 30 days to buy that thing back. Otherwise, it's just called a wash sale. But you could also do other strategies, such as double up. So you can double up on the position and then sell half of it at the end of the year. Now, there's a deadline to doing that. You have to wait. You basically have to double up before November 28th to do that. I don't know. I don't know if you've ever done that, but
I
that's
haven't.
what
And
it basically is about position.
no, as being declared a professional trader status, the wash sale rule goes away,
Right.
which
Yeah.
is a big benefit as well.
Yeah. I mean, other things like that. Obviously, you can sell a stock at a loss and then buy another similar stock in the same sector, or you just buy an ETF. That mimics that individual stock. But those are kind of some ways to get around the wash rule.
Yeah. Which may not impact it may not impact those that are really long term investors, but for those of you who might be a little bit more active, it's definitely something to consider. If you just dumped the QQQ and you took a big loss on that, if you bought back into that, you might not be able to claim that loss. If you do, instead of buying back in the QQQs, jump into something like XLK, which is very similar, and therefore you'd be able to claim the loss in the QQQs and have a new trade in the XLK. So finding something of a similar vehicle is certainly one way around that wash sale rule. Remember, you got 30 days for those trades to settle, unless you declare that you are a professional trader and qualify for as professional trader status.
Right, exactly. Another on the front of the investment side of things, obviously rebalancing your portfolios. I think people don't pay enough attention to that, but obviously through just simply market drift, where some positions are going up, other positions are going down. Sometimes they can get way out of whack, and I've seen this when people's portfolios where they'll walk in and what started off as a small part of their portfolio is like a 12% of their portfolio, and it's like, okay, that's a little bit risky having 12% of your total exposure to this individual stock. So
right.
Just either taking the time where you apply thresholds. In other words, hey, I want 25% into really aggressive positions. I want 25% in conservative, whatever that may be, and when they get out of whack, you just adjust them back down to their thresholds, or you just simply just make it a time thing. That's kind of why at the end of the year, I just remind people, look, I rebalance for my clients, but for those who control their own assets, right? I mean, yeah, rebalance. Take a time at October, November, and just like, all right, let's rebalance this portfolio. Let's make sure we're not overexposed or underexposed to certain areas that we want to be exposed to.
I think it's a huge piece for people, especially those managing a large account. The goal of, I guess, long-term wealth creation is to diversify your holdings, to make sure you're not exposed in too much area. And to make his example real simple, which I'm sure many of you here understand, if I took, let's say, $300,000 and I split up into three separate positions and it's evenly distributed. I put $100,000 in gold, $100,000 in the S&P, and $100,000 in a bond fund, right? At the end of the year, it's very unlikely that each one of those will be exactly $100,000. Maybe gold absolutely just soars and doubles in value. Now that's worth $200,000. The equity markets crash by 20%. Well, now that 100 is only 80,000, and the bond market being eviscerated right now, it's only worth 50. So now my portfolio is 200,000 in gold, 80,000 in S&P, and 50,000 in bonds. I'm at risk. My exposure to bonds is so heavy that the smart thing to do would be, okay, I do it every December 1st. I'll pick a date. I'm going to sell $100,000 worth of gold, take whatever tax hit that is, or if it's tax-free account, even better, get my gold back to 1/3 of that portfolio so that the whole thing is now back to 1/3, and do that every year. It's just a risk management tool, which I think most people completely overlook.
Yeah, exactly. I mean, and because when you think about your retirement stuff, your retirement portfolio, you want to make sure it's balanced, So just taking the time to do that, I mean, just put on your schedule every year. Just do it every November or something like that. So, yeah.
Yep. Pick a day. I've talked to a lot of financial people, and that they just are always saying rebalancing is so key in long-term capital preservation and protecting your account. So yes. All right. So investment planning number 2, we had wash sale rules and rebalancing. Question came through here from Lisa, which is actually, I think this is a great question. She says, if you dump a stock at a loss, can you turn around and buy that back within 30 days in a different account? I'm going to wait you answer, but I'm pretty sure the answer is yes, you can, as long as it's a separate account.
No.
No?
Because you can't even do it with spouses. They will find you and hunt you down. No, I'm
Wow.
not kidding you. You have experienced the wash sale rule. I mean, again, the chances of them exploring that or finding that out, that's probably low.
Huh.
But spouses can actually do that now, because sometimes one spouse will be controlling both accounts, like the husband and the wife's account, and they'll take a loss in one account and they'll rebuy it in the other account, and that counts as a loss. I mean, it's as far as, I'm not an expert on wash rules, but
Yeah.
I have been, that there's that, and there was another instance of somebody asked me about wash rule, and I actually looked it up, and I was surprised to see that, yeah, I mean, you try to beat the system, and it does count. So.
Huh. All right. Well, I guess
I
hold
know
on.
what it was. It was take the loss in the individual accounts and then buy it back in an IRA account. So a taxable situation versus a non-taxable situation. That also counts as a wash rule, apparently.
Yeah. Okay. Yeah, we had a weird little audio issue. I'm not sure but we had an audio glitch there. Not sure what was going on. It looks like it's actually on my end. It says it's not receiving enough video to maintain a smooth stream. So I'll see if hopefully it will go smooth from here on out. All right. Well, that's news to me. I would honestly have said that in one account you could, next account you can't. Well, as long as I'm just an active trader, I guess I'm not a financial advisor anymore. There goes my RIA, my 65 license, out the window, everybody. I had it many years ago. All right, number 3.
I agree with you. I thought the exact same thing, but I was in a presentation that told me otherwise. So.
Wow. That's good to know. Although I think that the simplest solution would be to just buy some competitor or some similar ETF in that industry. That way you're completely avoiding the wash sale rule. So let's talk about number 3, retirement. We are obviously more of an active trading show here, but I know a lot of people, I would say almost everybody here, has some retirement account. What are some of the considerations for retirement accounts?
First piece of advice is fund it. I think, and I know from experience where, being an active trader, you tend to not worry too much about the long-term wealth bucket and stuff of that nature. So, the first and foremost thing, you gotta fund them, right?
Yeah.
So whether you make it a 401k, IRA, Roth. I'm a huge fan of Roth. You've heard me on the show before. Yep. But fund them. Not only does that put away money for obviously your retirement, but it also has, depending on which ones you use, has significant tax benefits as well, to offset the income side of things.
And they raise those limits every year as well. So I think it's important, if you are contributing to a Roth IRA or just traditional IRAs, that you know what those limits are, and certainly don't overextend yourself. But if you got cash lying around, it might make sense for you to look at what those new adjustments are and maybe raise your contribution levels. What is it for this? What is it for 2023?
So, well, for like 401ks, it's 22.25. With a catch-up contribution if you're over 50, 7,500. The simple IRAs are, they're 15,000, I think 15,500 with a catch-up contribution if you're over 50 of 35. The SEPs, this is for business owners. SEPs are really fantastic if you're a business owner or, obviously you have your own entity set up. SEPs are up to 66,000, and those are obviously fantastic. If I use this for business owners where, again, you have a high income year, you still want to put away money for retirement. The SEP plan is usually a pretty good way to store a good chunk of it if you can.
Nice. All right. So we got, go ahead.
And I want to take this moment to remind everybody that Roth is, to me, one of the ways to go, because, and I know some people out there going, yeah, but I make over 200. I think the threshold is 218 or something like that. I make over 218,000. With as a married couple, I can't contribute to a Roth. Yes, you can. You can do what's called a backdoor Roth. I've explained this in other shows, but you simply contribute to a regular IRA. Now, there's no tax benefit. You make a contribution, an undeductible or non-deductible IRA contribution, and then you wait a day and you immediately roll it into a Roth. You pay the taxes on it and all that kind of good stuff, but now you are able to fund a Roth even if you're making, even if you're a high earner.
Right.
So get on the Roth.
The single of those limits there, I just got a don't need to text me. You can put it in the chat. 138,000 is if you're single. 228, 228, I believe, if you are filing jointly. 218 or 228, somewhere in that range. Yeah, definitely.
Yeah,
Roth is
it starts at I think it starts at 218 or something like that, where they, it's a stupid little small band, but yeah, over 228, you're not permitted, according to the IRS.
Right.
You're not permitted to contribute to things like Roth, but you can via the backdoor method.
Interesting. Something that's not very publicized out there, the backdoor Roth. All right, so we've got income. We'll go through my list. You did the income side of things. You talked about investment planning, kind of wash sale rules, portfolio rebalancing. We talked about retirement, making sure you get those contributions in by the deadline. And then your fourth one was legacy. What sort of thing do we need to plan for with regards to legacy?
Well, real quick, back on the retirement, if we don't mind.
Yeah.
I would also approach, for those of you working for some large company, a large employer, which is 500 people or more, go to the HR department and see if they offer a Roth 401k version. 85% of employers, large employers, I should say, offer a Roth 401k. Just most, less than, I think, 8% of employees actually know about it. But that's also an excellent way to save tax-free if you feel that that's a good route to go. And then the third thing that I wanted to mention in the retirement is HSA accounts. If you have the ability, if you have a high deductible account, a high deductible insurance plan, get an HSA account, not an FSA, not any other type, an HSA, a health savings account. You can set them up on your own. It is not only tax deductible, but all the money in there can grow tax-free, and the distributions are tax-free when used for, health purposes.
And heaven forbid that healthcare costs should go up over time, or the simple fact that we should use way more healthcare services when we get older. HSA, probably one of the best things you can do. So yeah, Liz said fund an HSA as well. Absolutely. If you have the possibility to get in the HSAs, I would encourage you to do that as well.
Yeah, absolutely.
All right. So are we on to legacy, the fourth one?
Let's do legacy, man, because, hey, folks out in Merlin's world here. But that's what we should call the show, Merlin's World. I like that. Merlin's magical world. Anyway, here's definitely, I will tell you, who cares about making all this money if you don't have your estate affairs in order? Because all you're going to do is just make headaches for everybody else in your life, your family members, your kids, your grandkids. It's just going to be a mess. So take the time every year to do a little bit of a estate review. And it's real simple. Go through your trust documents, make sure that everything's still, maybe you closed an account, maybe you sold a house, maybe you make sure the trust, if you have a trust, which I think is a really good way to go rather than a will. If you have a trust, make sure it's updated. If you have a will, make sure it's updated. On your retirement account, make sure that your beneficiaries are the way that you want it. Everybody knows you're going to hate your kid at some point. So if you don't want them to get any money, make sure make sure they don't get it. No, but obviously things like divorce happens. If a divorce happens, obviously definitely want to rework like your trust and your wills and stuff of that nature. But take the time to review your beneficiary designations, your trust, your wills, your power of attorneys, those kind of things. I mean, I just moved. We just moved into a new house. So obviously I got to make sure that all my documents reflect my current property, so that's included in the trust. Transfer, I had to make sure that my transfer of deed went over to my trust. So those little things can get away from you, but always make sure that you review those at the end of the year.
Yeah, I can't emphasize the trust part enough. I've had several friends over the past, I'll say probably 20 years, who have had their parents pass away, one or the other. Things aren't in a trust, and next thing you know, oh, they had a will. It becomes very contentious and infighting, and a lot of I guess family dynamics destroyed because of just lack of clarity and people all fighting for things. So the trust kind of makes it much clearer who gets what, how it gets allocated, and also some of the huge tax benefits that Justin and I have talked about in the past, the step up with your house and many other things like that. Put it into a trust, and not only from a tax perspective, but from a peace of mind for your family perspective. And then the last part of this would be from a litigation perspective. In many cases, you get a little layer of protection by having a trust. Nothing it's bulletproof, but it's just an extra little layer of protection depending on how these things are structured. So certainly encourage you to look at funding a trust. Boss Booba says, fund your trust. Yep. Get it all set up. That way you don't have any infighting or family squabbles over what assets. And beneficiaries make it very simple. If you got a bunch of trading accounts, log in, go to your beneficiary page, fill that out so that there's no misunderstanding or fighting over who gets those assets. One question I want to get to, Justin, real quick. Hold on. There was a question from, where is it? Lisa says, what's the max that one can put into an HSA? That is $3,850 individually, and I think it's $7,750 for a married couple per year for 2023.
Yeah, they pushed that to 7,700 this year. Yeah.
Oh wow.
So I think 7,700. Yeah, 30. Yeah, I think it's 7,700. Yeah. So yeah, I mean that's 7,700 that comes off your taxes. So
great.
Above the line deduction. That's nice.
You got it. Margaret says, is HSA better than long-term care insurance? Oof, good question. Beyond my pay grade.
Those are two separate things. Long-term care insurance is simply in the event that you end up in a long-term care facility pretty much for the rest of your life. Now, the pros of that is if you have that, it'll cover you. The con of that is that honestly, you're probably not going. That's probably not going to happen to you. Number one, even though at some point 70% of retirees will experience some form of long-term care, but it's usually not for the rest of their life. First of all, so funding a very expensive long-term care policy, that's always on a case-by-case basis with my clients. I'm not a big fan. There's other ways to help protect yourself that I think are a little bit more reasonable. But in the end, it's up to you. If you're really thinking, hey, I just want to protect it, and you're willing to pay that expense of long-term care insurance, then go for it. But the HSA is just for out-of-pocket stuff. I mean, unless you're able to fund the HSA and just grow it dramatically, there's no way that it's going to cover a significant amount of long-term care. So it's the HSA is just like an extra health pot, savings pot to dip into when you need it.
Right. You got to go get those routine checkups or break a leg or end up in the ER. That covers that. Whereas the long-term care insurance is protecting overhead and everything medically once you're permanently in there.
Yeah, exactly. Yeah. And it really is it's a big fear, but I know that, again, it's talk to somebody who's rational about it. I know if you go right to an insurance carrier, they're going to say, yeah, long-term care is great. You should definitely get this. But talk to somebody who actually can sell you insurance, but also can overlook your whole portfolio and actually look what's best.
Yeah. And that's one thing really to keep in mind. And I'll emphasize this with everybody, when you go in, especially insurance companies to get life insurance or, some product, they're salespeople, so be careful. They're going to be looking to make a sale. Go in armed with at least the basic knowledge. And my rule of thumb is I never sign anything when I'm there. I'll go home and do my own due diligence, do some research, ask around, talk to some people. And if I feel it is something that I feel would be beneficial for myself, my account, my portfolio, my family, whatever, then I'll go ahead and pull that trigger. But I want to make sure I'm not pressured into any of these sales tactics that, a lot of these guys will go and take Sandler classes and really get trained on the art of how to close that deal and get you to sign right now. Make it a rule to yourself. Never sign anything on the spot. Never. Just walk away. And they'll entice you. Oh, we'll give you a free bowl of soup and a hat today if you sign up today. No, just kidding. All right. I'm off my soapbox, Justin. I'm done.
I offer a full can of Campbell's chicken and rice.
Soup is good food.
Sometimes you have to, yeah, you know.
Yeah. Let's see. Can you make your trust your beneficiary? Yes, John. You can make for like bank accounts and things like that. You can make your trust your beneficiary. You really only do that if you felt that the person that was your beneficiary, let's say you wanted to give it to, I don't know, Cousin Joe, and you really thought that Cousin Joe was probably not the best at handling their finances or money, then giving it directly to them may not be the best way. You might be able to provision some rules within the trust on how to distribute that more evenly so that it doesn't get blown all at once on things they shouldn't be buying. All right, let's see. I want to make sure I have your website up here. Let me go out to theproactiveinvestor.com. Obviously, guys, today this was just a real high level, just things to think about with Justin. You know, we talked about the income side, which, of course, making making sure that what income you have is allocated the best, making sure that if you do want to contribute to causes that you like, you want to go to give to the local shelter or to your church or whatever, that those are done in the right way to help reduce your tax base. From there, we looked at investment planning, looking at the wash sale rule and different things, not necessarily ways around. I don't want to sound like you're doing anything illegal and circumventing the rule, but there are just plain common sense things you can do to get around some of the wash sale rules, which may help your account significantly. You had portfolio rebalancing, which is key. Retirement contributions, Justin and I would probably echo the same sentiment. Just do it. I know the markets are near all-time highs, so you're still going to put money in the account. You don't have to allocate it right away. You can keep it in cash, or you can keep it in a money market fund until you're ready to deploy that, but max out those contributions if you can, unless you have a better use for that capital. And then legacy planning, you know, one of the things that is probably lost in a lot of this and is very complicated and will be a full show is Social Security and Medicare payments and deductions and things like that. There is a whole strategy behind Social Security and how to take it, when to take it, and when to collect those distributions. That's another piece that's probably a much more in-depth conversation. But that is really your main focus of today from a end of your tax planning perspective with Justin. Did I miss anything there, Justin?
I mean, there's always stuff. I mean, like,
something.
You know, if you sell a highly appreciated asset like real estate, a business interest, there's ways obviously that I actually set these up, you know, to mitigate the capital gains over time. But yeah, I mean, that's pretty much, and you're absolutely right about the Medicare and the Social Security. I mean, this is why I know people look at each one of these. I'm like, hey, I'm just going to focus on that. It's not about focusing on one of these. It's about making sure that they all fit together in your overall plan because they affect one another. So, but yeah, I mean, I think you hit it, man.
I think you hit it. I'm just summarizing. I'm just trying to keep the page together here, because you wrote all the stuff down on the page. I was just keeping it together. What other things do you got going on? I know you don't do a lot of engagement events, but you do have your webpage over here, which I will bring up for you guys. This is theproactiveinvestor.com. You can go there. He's got all kinds of different education or event pieces for you. But if you want to know more, if you are interested, Justin is happy to correspond with you. You can hit here. You had a number on the front, didn't you? Or schedule a meeting. I'm sorry, right here in the front. Schedule a meeting if there's something you want to discuss with Justin about not just end of your tax planning, but many other things. There was one question I came through here that I saw earlier. It says, does Justin still do picks for his customers or something like that? Where would that one go? Well, two things. Number one is, do you still do, the picks for people or things like that? And are you a fundamental analyst or supply and demand? And kind of how are you looking at your investments and allocations?
Well, I mean, for my clients, I manage their portfolios. I don't do like the random picks anymore on that kind of stuff. I don't do that simply because there's a whole lot of liability issues on that now with the licensing I have. But no, I mean, fundamentals. What is that? No, I'm kidding. I'm definitely technicals. So I technicals are obviously how I position in and out, or whether I should actually buy it or sell it. Fundamentals is just basically gives me an idea of really the long-term aspect of it. So, but it's mostly technicals.
Nice. There you go. Anything else you want to share with us before we wrap up here for today, Justin?
No, man. I just thanks for accommodating me on my taxi run.
No, hey, I'm glad you did it. It's always great having you on the program and learn something new every time. Now I know about some of my wash sales in multiple accounts. I won't be doing that anymore. I don't want to get caught. No, I never worried about that anyway. But no, I always appreciate you coming on.
Honestly, I think that's only going to occur if you get audited or something.
Yeah.
But,
knock on wood. I do not want to have anything to do with that. DJ Rivers says, does Justin assist with setting up a trust?
I do. Yep.
There you go. That was quick and easy, DJ. All right, Justin. Well, hey, thank you very much. Drive safe over there. I appreciate the end of your tax planning. We'll bring you on in November, but we won't do an end of your tax planning thing. We'll do something different.
Sounds good to me, man.
All right, buddy. Take care, Justin. Thank you so much.
All right, buddy. We'll see you.
All right, bye. As that was Justin Krebs of The Proactive Investor, giving us a little bit of insights into end-of-year tax planning, and hopefully you learn something along the way. At least start thinking about it. If you are in that mindset of, okay, I've made some money this year. It's been a pretty robust year so far, so I'm hoping that most of you did rather well. Now, what do you do with that, right? Now, I might need to sit down and look at those numbers, and maybe that's even before I go sit down with a CPA and say, hey, where do I stand? Now, how do I optimize my rate of return, if you will, on my money by either giving to charity, rebalancing portfolios, looking at HSA accounts? There's a lot of different things that we can do, and there is no clear-cut one-direction policy. I think what I liked about what Justin said is because I don't want you to focus on one thing. You got to focus on all four of these and kind of map out your master plan. It's a pain in the butt. It's daunting sometimes. But the benefit for you will be peace of mind, better understanding of exactly where you stand financially, and optimizing the money that you have and hopefully the taxes that you will be facing. So anyway, I wanted to share that one with you guys. Hope you enjoyed that. Thank you, Justin. I appreciate it as always. Let me dive into what happened out there today. I received several messages today asking me if I had closed out my Russell trade. I did not. I really feel like it should keep going. I see Michael saying, why did the market sell off so bad? And was interest rates the main reason the market sold off? It's a combination of many things, and we've been talking about it for at least a year on this show. So, at some point I was bound to be right that there was a pretty good correction coming, but it wasn't necessarily that there's a correction. It's just saying that the impact of what we saw with COVID, all the relief, all that money that came pouring into the markets, all this debt that we accumulated. I mean, the angle of debt from 2020 is unlike anything I've ever seen in my life. It is unbelievable how much money was poured into the economy from 2020 on. You can't do that and expect markets to act normal, right? It's literally like taking a morphine pen and injecting, actually more of an adrenaline pen, and just juicing somebody over and over and over again with this adrenaline pen. Eventually they're just going to explode because the body just can't handle it. I think that's really what's going on with our markets have gotten to the point that they're so juiced, and there's so many headwinds, right? If you look at the debt right now, you get $33 trillion worth of debt, and that's starting to weigh on these markets. So here's your NASDAQ for today, right? Here's your NASDAQ 100s. We actually aren't even at that breaking point yet on the NASDAQ. Even though we're down 1.8% today, you look at this chart and it's like, okay, well, we're nearing that line that I've got drawn out there, which is 14,609, but we're not there today. We got to a low today of 14,651 on the NASDAQ futures. I still think we're going to hit this little yellow box down below. The Russell just fell apart again today. Of course, in hindsight, I wish I didn't sell half my position yesterday. I wish I would have kept that because it would have been even better, but it's okay. Still got half my position rallying. I actually thought about closing it out today because we're kind of deeper in the zone, but I'm going to kind of try to keep this till we get down towards these lower levels, which is right around 1650. Now that would be a heck of a drop. That's another 90 points away from current levels, which would be roughly, let's call it 7% lower. Could it happen? Yeah, I really think that we could do that. So I think what you have is the market now just realizing that we're not in as rosy of a position as we thought we were in. The government is in a bad spot with regards to its debt situation. And if we look at the 10-year bond today, look at the 10-year. We broke 4.8% today. I'm going to, real quickly, just because I like participation, I'm going to go and copy a link to this tweet. Hold on. See if I can actually bring up that specific tweet. I'm going to post it in the chat and let you guys vote on this one. I think this will do it. Control-C. Control-V. Let me know if that link works for you. It's just a Twitter poll that I posted, and I'm curious. My Twitter poll is, will we see 9% rates on the 30-year fixed rate mortgage this year? I mean, we are surging aggressively. And let's look how much this 10-year has moved in the past. Let's look at how long it's taken it to move 1%, a full 1 percentage point, right? We go from 4.8, I'll go down here to 3.8. So right about there. It took 52 days for us to rally a full percentage point in the yield, meaning we went from 3.8% to 4.8%. So in theory, could that happen again? Could we take this and just move it up to the top and kind of see how long that would take? Well, that would get us right towards the end of the year. And that means that the yield, if we move up another 1%, we'd be right around 5.8%. At 5.8%, you're looking at a 30-year fixed rate mortgage of over 9%. So I put that poll out there just for fun. If you have time, click the link that I just posted in chat and let me know what you think on that one. That would be, I'm interested to see what you think there. But, we look at where this market is headed and the pain that it's facing. Well, we are at some very interesting moments right now. So let me run through our top 7 here, and I'll dive a little bit deeper into Michael's question about what on earth is going on here. We've got the crypto side of things. Again, I am in the school of camp that says be very careful shorting crypto right now. I do believe strongly that we're going to get a Bitcoin approval. There was news came out today that the SEC has been reaching out and talking to multiple firms that have applied for a spot Bitcoin ETF to get clarity. Pressure is just avalanche on top of them right now trying to get this approved. So I'm pretty sure we'll get it here in the coming months. NASDAQ, as we mentioned, ugly day. I feel like the uptrend is over. I feel like we're now starting to make lower highs. What we need to get with this NASDAQ is some lower lows. So if we get down below that red line I drew on your screen, which is, I'll get all these other ones off. Once you get below that red line, you see that little yellow box I've got mapped out. After that, now you're talking some much bigger falls going forward. So, we're kind of at that inflection point here on the NASDAQ. The Russell has already broken down below it. The question is, do some of these areas of demand that go back into May and of March support right now? I mean, we're literally coming right down into that zone. Is that the next stopping point? Probably. I think it's way overdone. I think this is, a pretty aggressive sell-off by any stretch, particularly with this Russell. We looked at the actual percentage slide over the past couple of months, at least since I started this position, 4.61% just in the last 2 days. But if you go from when we initially talked about this trade, going short the Russell, it's down 10.32%. Anybody in here that trades options, if you're directional on options and you bought deep out of the money options and it rallies 10% in your direction, oh man, that is a great trade. Which major market leads, the Russell or NASDAQ? Leads us down? Great question, Margaret. That's a really good question. Historically, we would say the Russell, right? The Russell is the proverbial canary in the coal mine. And it's a belief that small caps, in times of hard times, you'll see them fail sooner. Now, I don't have the stat here. Actually, I might be able to send it over to us because I took a screenshot of it. I saw it on Twitter and I was like, dude, this is a great chart. Yeah, it's the cumulative small business declines. Let me email this to myself. This is going to seem kind of clunky way to do it, but I need to do this just so I can get it over to you guys so you can see it. It deals with the number of small business failures and filing for bankruptcy right now. That is important because the more that do that, the more likely you're going to see the Russell sell off. And that's the historical dynamic. The historical dynamic is in bad time, when markets are about to turn and get worse, small caps feel the punch first. When markets are in turmoil and getting beaten up, the small caps might be the first ones to benefit from the market rally because money will look at those cheap companies and cheap valuations and buy them because they'll feel there's a bigger turnaround coming there. So a couple different ways to look at it. But right now, I don't know, Margaret, if that dynamic still holds true. I'm going to copy this and I'm going to put it into our PowerPoint so you can see that. The reason I say I don't know if that dynamic is going to hold true is a couple different things. But the main one is we have tech is so heavy, is so powerful. If tech continues to roll over, then tech's going to be the lead dog, period. I think that's probably the most likely outcome, is that tech will be the leading this one down, which means NASDAQ will be the leader, not the Russell. So right now, if you look at the picture, Russell is. Now here's one graphic. I got it over there, so thank you, TJ. This is the number of cumulative small business bankruptcies each year, going all the way back into 2020. And you can see that there's, it seems like it's been rising every year, But this year in particular is considerably higher than the previous 3 years, which basically the number of companies filing for bankruptcy. So that is a pretty ugly picture here. Right now we're at 1491 with 3 months left, and the high that we saw back here in 2022 was just over 1500. And we're already at 1491. So we'll probably eclipse this by a good margin. The question is, do we get to that 2,000 mark? This could be pretty bad for our markets overall. Anyway, thought I would share that graphic with you. I know I've got all kinds of weird charts. Sometimes I see things that just draw my attention. I'm still keeping my eye on both of these, Margaret, which is the small caps. I mean, if you look at this chart right here, it's definitely been leading to the downside when I look at that compared to things like the NASDAQ. NASDAQ is just rolling over. I don't believe that the straw has broken NASDAQ's back yet. If it does, and maybe what's going to require that is the Russell selling off even more. Right? If the Russell continues and gets down to that level that I want it to get to, which is this 1650 mark. What is with my charts? Oh, maybe it has to do with these lines I got drawn here. Oh, that's probably why it's all messed up. 1650 is that line that I'm looking at. And again, if we get down there, that'll probably pull our NASDAQ down lower and start triggering more sell-offs. You're also seeing some issues with Google with antitrust, Apple with all kinds of issues around the globe. So I think that once this breaks, then the big move will happen. Yep. Yeah, right, Margaret? I mean, it's not like it's guaranteed, but it's definitely holding now. But what's noteworthy here is I look at this part right there. I'm going to just, all right, if we just look at this picture right here, there's not a lot of strength here. There's actually weak. And I've just zoomed in till, mid-June to current markets. And you can see we were making higher highs, but now all of a sudden it's just getting weaker and weaker. And I've got these red lines drawn. That was just a simple illustration of a descending triangle at the peak. But when I zoom out, I mean, we're definitely due for a correction. Way overdue for a correction, in my opinion. So, hey, well, good to see you, Obioma. Hello from Lagos. Hello from Southern California. All right, so we talked the NASDAQ. We talked the Russell. S&P. All right, this one, I'll tell you this. I do think we're going to have a bounce. I don't think it's going to be a big one, but I think right now we're getting oversold to a point that there is a little bit of panic going on. So I do think you're going to get a little bit of a bounce. I actually did sell some SPY puts today, thinking we would get a bounce. I did them pretty close to at the money. Let me look at SPY here. I forgot my strike price, but I can tell you by looking. It was not 420s. I did I think I did 418s. So, yeah, I sold the 418 puts today because I do think you're going to get a little bit of a bounce. If you look at this, you can see that's like an origin of a nice move right there that goes all the way back into June 1st and May 31st. But if I look at the ES, it's right in that zone that goes all the way back into June, and I'm kind of holding on to that one. We'll see. I might have to see what the rest of this week looks like before I make that close. Now, the other part here is gold continuing a pretty ugly slide here. I am still long my silver, not doing anything about that. Again, I sold the $19 strike price on silver, sold those puts, so I'm okay buying more. If anything, I do think we'll drop further down to 1820 on gold futures, which is not that far away. I mean, today we hit an intraday low of 1830, so just 10 points away from that line. Some would argue that's the beginning of your demand zone right there. So ugly day for most of the major market indexes, and again, goes back to these markets right here, that 10-year bond. I saw a post today, and I had to tweet out about it. Somebody was posting, TLT bondholders are getting absolutely annihilated. It's like, yeah, why would you be buying TLT right now? We can't go any lower. Well, you're not buying TLT. You buy TLT, you're actually saying, I'm going short the bond market. And why would you short this bond market right now? I mean, that has got to be one of the dumber moves that you can make is shorting the bond market. It's almost a foregone conclusion they're going to keep going up. The yield curve has to get back to normal. It's just the nature of markets. And our government with so much debt, they've got to sell more bonds to cover it, therefore higher yields. Expect this to keep going, folks. I don't know if you guys saw Rick Santelli. So Rick Santelli is probably my number 2 favorite person. Art Cashin. Art Cashin is my number 1 favorite guy. He will always be. He'll probably stop being on CNBC soon. Just an old curmudgeon, but I tell you what, he is awesome. That guy is an oracle, in my opinion. I listen to every word that guy says. Rick Santelli did a really good thing talking about the bond yields. And I was just like standing up going, yes, exactly. He thinks we're getting to 13%. 13%. Now, I don't know if we're going to go that high. Given the fact the short end of the yield curve is at 5.5% right now, my guess is the long end, getting to that 30-year, might get up to, let's say, 7. If we get to 7 there, then your 30-year fixed rate mortgage is going to be closer to 10 or 11%. So that's a challenge. I know a lot of people can get freaked out about that. Overbought can get more overbought. Certainly. Overbought is a horrible. Overbought and oversold are two words that I almost want to throw away out of our trading vocabulary. And why? Because when you say overbought, instantly your brain says, "Oh, it's overbought," which means it's got to come down. No, overbought leads to more overbought. Oversold leads to more oversold. With the phrase that I think is better is this graphic right here. The trend is your friend until the bend at the end. There is no bend. This one's still rallying, and I'm nervous about it. And again, what's my poll say? I get a new couple of you voted on that poll. For those of you who didn't, click on that link in the chat. I want you to vote on this one to see if we're going to get 9% rates by the end of this year on our 30-year fixed rate mortgages. I did not vote, but I know exactly what my vote would be. I am not going to sway your decision there, though. Okay, so what else do we have on our equity markets? Oh yeah, we had the dollar index. Dollar still ripping. I mean, today was a huge rip up. Now, it gave a lot of it back, right? We had that giant candle yesterday on the dollar index. We broke 107 and closed above 107 today. Now, this is a very interesting hesitation candle. I'm looking at it from, I told you, I think there might be a bounce tomorrow. Well, I can take this little line right here, put it against the lows of today, and that 106.908 mark is what I'm looking at right now. If we drift down in the next, 12 hours, and by tomorrow morning's open, we're above that and then break it, then I think you got a very good chance of a nice market rally tomorrow. But we have to get the dollar to slow down, and you got to get this 10-year bond to slow down and move the other way. So I know INF, it does look oversold, and that's why I say I should remove it from my vernacular. Like, I think that the Russell is, technically it's oversold, but that doesn't mean this trend is over. What I'm looking for is just a little bounce off of demand, right? Same thing with this S&P. Yeah, I know. I'm not a fan of those terms because I think it psychologically implies that it has to bounce. Well, it doesn't. Right now, this one is pretty ugly to the south side. This is definitely catching a falling knife. I'm okay with the demand zone, even though it was tested about 5 days ago on the S&P. And then finally, crude oil stopped its sell-off again. We've had this line at 87.38 where I thought it would come down to. We got fairly close today. Our low on this was 87.76. Bounced up just a little bit, posting a green candle up 0.46% on the day. So there we go for our overall markets. One last piece here that is interesting. Again, the yield curve. Look how quickly the yield curve is closing. So we've been underwater on this yield curve, meaning inverted, since June of 2022. So we are, 16 months now? Something like that. We've got a ways to go. You're still inverted by 36 basis points on the 10 and the 2. The 10 and the 1 is a bit worse. I can't, Margaret. Because when I log in, what does the URL say? Right there. It says Twitter. I have to call this Twitter because the URL is Twitter. That's just the rules. I don't know if it was x.com, then I would call it x.com. It's Twitter. I know. Because here's the problem I have with that. If I say anything about X, that doesn't work for me because X is U.S. Steel. It will always be U.S. Steel. There's X. Right? That's the U.S. Steel. So it can't be X. Ticker symbol's taken already. Gone. Damn you, Margaret. In the past, after the July 4th weekend, the oil always goes down because people drive less after summer is over in the past. Well, you can never say always, right? There might be a higher probability of that happening, Michael, but nothing is an always. I would never use the word always. But you're saying after July, you think that oil goes down. Well, if anything, oil should be going up. We still are, July, August are still travel months for the U.S. Now, granted, most of it's going to happen in June and July, but still, it's a big travel. I don't think that's what's impacting oil right now. What's impacting oil right now is, number one, the price of the dollar, and number two, OPEC and supply changes. That's the main pieces there that are impacting what's going on with crude oil, and I don't see that changing. We had my forecast, which is 100 by the end of the year, which I still think is in play, and then this other line, which I will change colors here so we don't get them confused, is I think one of you mentioned that was what JP Morgan or Goldman Sachs gave their forecast. I'll put it in blue or purple, whatever color that is. Gave their forecast of 150 on crude oil, not by the end of the year. I definitely think that there's some upside potential here, but not by the end of the year. That's a little bit too much. Let's see. What else do I got? That dropped happened after the JOLTS report. Might be just a news daily candle. We'll see tomorrow. Well, the JOLTS job report isn't really that significant. It certainly is an economic report that comes out and people look at it, but it's not like I don't think it's that critical. It's not like this major one that you're like, oh, here comes the JOLTS job report. Let me go to Forex Factory and show you the numbers that came out today, just so you can have that. Here is your screen. So there's your JOLTS job openings. This is good. This means there's way more jobs than expected. Now, does that mean we're having more unemployment? I don't know. 9.6, great. If you look at the grand scheme of things here, let's shoot this one all the way back into 2004. There's jobs, people. There is jobs, lots of them. Even if we drop way down here to, let's say, 6 million, okay, still plenty of jobs compared to historical norms. So I don't really put too much emphasis on the JOLTS job openings. The other numbers that that I do put more emphasis on are happening later this week, and that's going to be your unemployment rate on Friday, and then tomorrow, which nice segue there, or actually that's the JOLTS. Let's go to today's. There you go. I'm sorry, not today's. Tomorrow. There you go. ADP. So here's your announcements for tomorrow. You have a ton in the services sector, right? You have Spain, Italy, France, Germany, and the EU, as well as the United States coming out with their services PMI numbers. That's good to get an idea of how all of them stack up. And then you also have the British pound. So pretty much the major developed countries all coming out with their services PMI numbers. The ADP non-farm employment change is a much more widely watched one. Notice the expectation here is a pretty sharp decline. Now, I will zoom in past the COVID pandemic part to see what it looks like. We've been drifting down the past 3 months, pretty aggressively, I will add. Right now, they're expecting that to continue down. Now, what does it look like long term, like we just looked at? Well, it's hard with that number there, but typically, you're looking at 90 to 100, maybe 200,000 on that ADP non-farm employment change. We're at 154. So technically, we're not doing too bad. We're actually doing okay on that ADP non-farm employment change, but that's one that can certainly move these markets. Do we make it an hour? Dab nabbit, Boss Poopa. It's because you guys keep asking me questions. I would not have known it was an hour show. All right, well, I'm going to have to wrap up then. I could just keep going and going. Energizer Bunny over here. All right, let me wrap up. Earnings calendar-wise. So I already went through economic announcements for tomorrow. If we look at the earnings calendar, you do have some stuff going on. Let's bring that one up for you. Here is your calendar. You've got Tilray Brands. Look, these are all really small ones. RPM International, Acuity Brands, but a lot of this is really small. This week is very light, boring, if you will, with regards to earnings announcements. It's all about next week, which I will let you know in the Monday Morning Must Know. So, yeah, no problem, guys. It was fun. Unfortunately, I didn't get to some of the viewer questions. I will get to some of those tomorrow, but I have another announcement for you. Thursday, I'm going to have Bill Addis on the program. Some people have asked me to get him back on. There's a lot going on with the bond market, and I want to bring him on just to talk more about it. So Bill Addis will be our guest on Thursday's show. I have no guest tomorrow. Friday will be a whiskey day, and then all next week, no shows from me. Not one. Sorry, I will be in a classroom teaching, which is the first time for me in a while, so that'll be fun to do. It's good to get back into the classroom and educate in front of physical students. Totally different experience. Anyway, if you guys have any comments, questions, feedback, any newbies out there, hit that subscribe button. You can email me at TraderMerlin@gmail.com or put your comments down below any of the YouTube videos. I'll be happy to get to those and add them to my show. And the more time you give me, the more likely I have time to prepare some good graphics, etc. for you. So that's going to do it. I will see you guys tomorrow. Take care, everyone.